Let's talk about the banking space, where no less than 6 Nigerian banks turn in their quarterly earnings this week, 3 of them today. So we're getting a sense of this in what the trading day will end today. The majority of these from the bulk of the country's biggest lenders. But what are some of the facts behind the figures? Joining me now for a 2-part conversation on this is Joshua Adebisi, who is the head of banking analysis at Vetiva Capital Management. Good evening, Joshua. It's good to see you.
Good evening, Boston. Thank you for having me.
Thank you very much. So are these banks' earnings so far this week in line with your expectations as a banking analyst?
Well, yes. Short answer. All the banks that have released have either met or exceeded our expectations. I think GT was almost perfect across the board, where we saw gross earnings coming as expected. Although overall PAT was down by about 3%, but this was expected due to the fact that impairments were up to about 10 billion, which we expected to happen. When you look at Zenith Bank also did quite well. I think the most impressive part was that the impairments did not go up as much as we had anticipated, but still they came in with about 158 billion in PAT. Access Bank was, I think, the strongest performer. Year on year, the overperformance, I think, was down to the fact that the non-interest income was significantly higher, and they were able to fully manage their operating expenses, and also they didn't have too high impairments. So all these banks that have released, I think the general sense I'm getting is that investors were a little bit disappointed. However, I don't think that should be the case, because overall market performance did not, well, due to the fact that the economy was a little bit shaky. It was always expected that there would be a little bit of up and down, but overall I think the banks did quite well considering, the economy.
So what do these bank earnings, Joshua, what does it reveal about the underpinnings of the domestic economy? We're going to get our third quarter numbers. We're going to get a GDP latest numbers on Monday, and then the monetary policy meeting on Monday and Tuesday as well. We already have inflation indicator, as well as the November PMI, which shows our manufacturing PMI now at 50.2. At least we came out of negative position in October of about 49.2 to 50. Industrial numbers yesterday published by the central bank was around 51.7. So what do the numbers by the banks, what does it tell about the economy itself in terms of the lending to the real sector, the whole idea by the central bank that all banks should just move ahead, lend more, and lend more, whether you're using the CRR window, whatever window, just keep lending to the real sector?
Well, Boston, I think based on the results, we can say that the CBN's tactics have worked, simply due to the fact that we know that the fixed income space has been summarily decimated, really. So there's not really that much joy for banks in that space anymore. But also, I think there's a bit of encouragement we can take from the fact that there is, when we look at the impairments, most of the banks did quite well, like I mentioned before, and none of them, exceeded our estimates. A lot of them underperformed our estimates, which is a positive. So that just means that even though the banks are being forced to lend to the real sector, impairments, non-performing loans did not go up, like some would have anticipated from all the increased lending to the real sector, but that did not happen. So I think that actually puts us in a better position, because when you drill further down into those results, you see that a lot of the NPLs, were stacked up from Q2, although there was a little bit of an increase across 1 or 2 banks in Q3, but still overall the performance is still in line with expectations. So we can say that NPLs have not worsened too much across the board, and they should not be so much higher. Industry NPLs should not be that much higher. The economy has not completely flatlined, and people are still making payments, which means money is still being generated and the economy is still moving, albeit slower.
Yeah, so when you look at deposits, for example, in Union Bank, which was reported just 2 days ago, 1.1 trillion naira from about 880 million in the previous period. That tells you that, yes. Where does the money come from?
Well, I would say it comes from increased activity and from the fact that, people are looking at the economy as a whole and, probably figuring that there's not that much joy to be had from investments. Maybe some people are just not, interested in playing in the equity space, so to speak. And so they're just keeping their money in the banks. But I think deposits alone don't tell you the whole story. In the case of Union Bank specifically, I think it's quite impressive that they've, crossed the 1 trillion naira mark. And I think, that is a positive for them going forward and maybe, looking to become a bigger player in the financial space and, giving out more loans. But when you look at all the other banks, you can see that most of them didn't see that same, level of increase in deposits or change in, the structure of their loans. So I think maybe that was specifically to do with a strategic, play by Union Bank specifically.
Okay, so I'm looking at some of the earnings per share. We will talk about those of Zenith and UBA a little bit later. But look at GT Bank earnings per share was down to 502 kobo. Sterling Bank earnings per share flattened at 26 kobo. Non-performing loan ratio in Sterling Bank was 2.9 from 2.2 previous. So you think this investors should, look at the banking sector index today, 2.16% negative.
Well, so like I said, perhaps investors are a little bit wary, but I don't think there's any reason for that. I also believe that it's a bit down to some profit taking, so we shouldn't read too much into any negative movements we're seeing in the market at the moment, because I don't think these results, although they're not, last year we saw pretty significant gains year on year. By the 9-month mark, we knew that we were going to see record profits for your big banks, for your Zenith and your GTs. This year, that will not be the case. Some banks will see revenue go down a little bit, but I don't think it's as bad as, it could have been, because if you see South Africa, if you see Kenya, those countries, their top banks reported losses. They reported losses in Q2, they're reporting losses in Q3, and, they anticipated getting worse. Their NPLs, some of them wrote off, majority of their loans at some stage. So that tells you that the fact that we're still, just seeing 0.3% increase in NPLs in some cases, that tells you that the banks have done quite well and we should be impressed. So any kind of profit taking you're seeing, I don't think will last that long.
Yeah, I'm looking at Standard Chartered, as we're just talking about other jurisdictions. We'll talk more about that later on the show at about 7:30. But right now, Standard Chartered in Kenya, one of the largest banks in Kenya and in Africa, Standard Bank of in Kenya is reporting third quarter profit decline of 30.6%. That's huge.
Yeah, exactly. So you see, those massive levels of losses compared to our market, where you're seeing less than 10% swing, into the negative anyways. In some cases, we're seeing, more than 10%, 15, 16% in the case of Access Bank swing to the positive. So, I guess it's a quirk of our market that we don't really follow the trend, especially our banks, due to the fact some people will put it down to, fees and commissions. Some people will put it down to our investment trading and, gains on investment securities, fixed income securities and derivatives and the like. But I would just put it down to efficiency. I think our banks are extremely efficient. And in fact, I think that wariness to give out loans has actually served them quite well. Because they've been so wary, they haven't been, spreading themselves thin.
I understand what you're trying to say. Just make sure you understand your environment, and once you do that, you can understand very well. Stand by, Joshua. We'll continue this conversation when we come back after the break. The monetary policy meeting is next week. We have a whole lot more to talk about. What your thoughts are around these and the GDP numbers coming on Monday. Okay, let's get back to the show around a very big earnings reporting week for the Nigerian banks. And of course, not just here, but across frontier Africa. And a bit of that. So, you're looking at UBA, Zenith, FBN Holdings, GT Bank, Access, 5 of Nigeria's biggest lenders that will talk about the commercial banks. 9 months, you consider the gross earnings for UBA, profits before tax at the doorstep of 90 billion. Zenith came in with nearly about 500 billion naira gross earnings. Profit after tax, that's about 260 billion. I just usually refer to Zenith as the king of Nigeria's banking sector. FBN Holdings, operating profit 62.3, profit after tax 68.2 billion. Gross interest income for GT Bank that reported just about 48 hours ago, nearly 220 billion. Profit before tax 167.7, and we spoke about the earnings per share earlier, about 509 kobo. Then you look at Access, net interest income 670 billion naira, and earnings per share 116 kobo. So next week, the final meeting of Nigeria's central bank's monetary policy meeting will take place starting on Monday, and analysts such as Joshua Adebisi are now looking for sound bites, or they will look at least for some signaling, as it were, from the financial regulator about the state of the banking industry and the financial system in general. Let's continue this conversation. Joshua, thank you very much for standing by. So let's drill down a little bit further into these numbers that we just have on your screen. I'm sure you've drilled down a little bit more into them, and we'll be talking about it. So in terms of, do you think the remaining banks' earnings will trend along the lines we had this week?
Yes, absolutely. I think that it's quite obvious that performance, 9-month performance up till now has, tracked a certain pattern, which is, slight variance in interest income depending on the bank, but definitely across the board we've seen much lower interest expense. So that gives you either, a plus or minus 5% swing in net interest income. Meanwhile, non-interest income, we've seen fees and commissions a little bit skewed due to the fact that the CBN changed the regulations regarding that. So a lot of banks have reported lower net interest income. And then another one that's on a bank-to-bank basis is fees and not fees and commissions, income from investments and investment securities. Now, some banks have done quite well on that. I think Access Bank did pretty well in Q3 compared to previous quarters, and they realized some gains that sort of offset some earlier losses. Meanwhile, your UBA, not so much. I think your Zenith Bank also, GT quite, fairly standard in terms of income from investment securities, but that's not really where they play for now. I think going forward, we might actually see a bit of change in the makeup of GT's profits due to the fact that, they're going to enter a new structure going into the new year. So I think that's going to actually have a bit of impact on their earnings. So I think there was a little bit of a discrepancy there because Zenith Bank have only done 159 billion in profit for now. 259 would be more than they made in the whole of last year, which would be quite a feat, actually.
Thank you for your eagle eyes on that. Thank you so much. Just a typo. Thank you so much for making that correction. We appreciate that. What about the FX issue, the exchange rate, and the whole issue around whether the naira depreciates and all of that from the monetary policy side? Do you think all of that are now out of the window for Nigerian banks, or still they will continue into Q4?
Well, for the rest of this year, the chances are everything will stay the same. Definitely the CBN will not want to, cause any upsets at this point, but any kind of, negative change to the currency would definitely positively impact, all the banks' final year, full year profits. But I think we can save that, sort of bench that until 2021. But for now, it's pretty obvious that the banks have sort of bet against the naira, at least in general, and I think it's the right thing to do, because if you take a long position, right now on the naira, chances are you're going to be, counting your profits by this time next year. So definitely it's something that's going to continue to cause the wider economy a lot of, heartache, I think, because of the fact that you're going to continue to see the currency devalue due to the fact that foreign investors are not really coming into the market because of, all the external factors, as well as the fact that they want us to devalue. They want us to actually float our currency and let it, run in a free market so that they can enter and exit as they like. Right now, there are a lot of FPIs who are unable to exit the market just due to the fact that they don't have any FX coming in from the CBN, and so they've had to get a little bit creative because of that. So all these factors will continue to impact the naira, and I think the banks know this, and they will continue to bet against that, and it will reflect in their profits.
So is there any idea that if there are no major changes in both monetary and fiscal environment, the banks will continue to remain on this trajectory in Q4 well into 2021?
Well, yes. On a simple numbers on paper, going forward, absolutely. If nothing changes, even if the CBN comes out and lowers MPR once more, which I doubt they will do this year, the truth is all this will really do is make it cheaper for the banks in terms of interest expense, maybe a little bit cheaper for the common man to access a loan. But the truth is, all these factors will only positively impact the banks, at least in the final few weeks of the year. But going into 2021, that's a whole different kettle of fish, because inflation is so high right now, and if it stays this high for the next few months and into next year, then this will start to erode all these real monetary gains that you're seeing.
A final one, Joshua, how much more impairments on loans do you think the banks can afford to take on before they will start feeling the heat significantly?
Well, I mean, so the CBN's benchmark is 5%. Currently, the industry rate is, I think, about 6.9%. Well, that was at H1, but I think that would be a little bit higher by the time we do the calculations after all these results are out. But overall, there's still a long ways to go, because if you recall, during the height of the recession, I think around 2016, NPLs did not approach 10%. So I think we're still in a very, very safe spot, and there's nothing that we can foresee at the moment that would drive NPLs that high that fast. So I think everybody should be, pretty comfortable with where we're at right now.
So the central bank says that the banks are well capitalized, capital adequacy ratio, solvency issues are well in place. You think this will continue into next year? How long do you think this will continue if the economy does not rebound very quickly and strongly?
Well, okay. So in terms of capital adequacy, actually, I'm glad you brought that up, because we've seen a lot of banks, go into the debt market to raise capital due to the fact that all these naira devaluations have actually impacted or eroded some of their capital, and so I think that is one factor to always consider, is the fact that if our currency is unstable and is continuing to worsen, then banks will always have to come out and seek more capital in order to meet up with their capital adequacy ratios. Now, going forward, I think definitely there will be a little bit of contingencies or plans in place by these banks, but overall I think we should expect more access to the debt market. I think over 600 billion was raised from the debt market this year, and I expect that number to go up significantly in 2021 as well.
Joshua Adebisi, thank you so much, Senior Research Analyst in charge of banking at Vetiva Capital Management.